What's up, guys? I'm Nobody Special. Europe is running low on natural gas. The underground storage tanks in Europe broke below the 50% capacity mark yesterday, and that marks the earliest point in the home heating season ever that levels have reached that level, beating the previous record by a full 7 days. And although Europe has seen some relief from LNG cargoes from the States and warmer weather has set in, the sudden onset of cold weather could send those energy prices right back up to those historic levels. You ready? Hit it. Thank you for joining me. I'm Jack Gamble, and I'm Nobody Special, and Europe is really in trouble in their natural gas markets. Their underground storage tanks are half empty. I'm sorry, I said I was going to be more positive this year. Europe's tanks are now half full, and this is the earliest point in the winter heating season ever that Europe has reached that level, a full 7 days earlier than the previous record. Now, Europe has had a little bit of a break recently. The prices in the all-important Dutch TTF gas hub have come way down from those highs we saw in December, helped by warmer weather and a fleet of LNG tankers from the United States. But if that weather breaks cold again, those prices are going right back where they came from. Now, before we get into the details, I have to ask you folks, could you please like this video, subscribe to my channel, and hit that notification bell? It really helps me out, and I'd be forever in your debt. Now it is that wonderful time when we shrink my big, fat melon of a head, and let's get into this article. And this is in Bloomberg. Earlier than ever, European gas storage is half empty. Again, I'm going to be more positive. Half full, half air, however you want to look at it, half out of gas. Russia is restricting supply westward and tweeting reminders of the perilous gas situation faced by Europe. It seems Gazprom, the largest Russian natural gas conglomerate, has been something of a bit of Twitter troll recently, taunting Europe with their higher prices. And this is dated today. On Christmas Eve, Gazprom, the Russian state-owned natural gas giant, tweeted a rather unfestive message. Gas inventories in Europe were depleting quickly. Since then, Gazprom has been reminding the world of the trend every few days. It should be noted that gas reserves in Europe's UGS, or underground storage, are currently at their lowest level for the season in the long history of observation, it tweeted again earlier this week. Gazprom is right. On Thursday, Gas Infrastructure Europe, an industry association, announced that the European gas inventories had dropped below the key 50% mark of total capacity, down to 49.33% as of January 12th. It's the earliest the half-empty mark has ever been reached, beating the previous record by 7 days. Typically, Europe's gas inventories don't fall to half until about early to mid-February. During some milder winters, the inventories don't sink below midpoint until early March. And what we have here in this chart, it's a little difficult to understand. Let's zoom in here, but this is showing across the whole year what the gas storage inventory levels look like. And up at the top here, this is 2022, and you see we've broken into that 50% range on January 12th, and that is much earlier than we've ever seen in some of these previous years, 2017 being the previous record, and we are way ahead of those 2017 numbers. Now, Europe has gotten quite a bit of relief from these higher energy prices in the most recent weeks. We've had much warmer weather has set in Europe, and this fleet of LNG tankers from the United States has helped to top off supply. And here we can look. This is the all-important Dutch TTF natural gas hub. This is the benchmark for European gas futures. And you see we reached this astronomically high level on March 20th of 179.88. And since then, we have come down quite a bit as the weather got warmer. A little bit of a bounce, and now we're sitting right around 75. So natural gas prices in Europe are still about 5 times what they sell for in the United States, which is historically very high, although just a fraction of where they were trading only a few weeks ago. I have to remind you folks, if the weather changes or if the geopolitical situation in Eastern Europe were to deteriorate further, those prices will go right back where they came from. And on that subject of US LNG, I just want to show you a little bit of this detail. Now, this is in Natural Gas Intelligence, and this is dated January 7th, saying LNG cargoes continue diverting toward Europe. Keep in mind, this is a week old, but this is still the case. Liquefied natural gas tankers previously en route to Asia are still diverting toward Europe as the western part of the continent continues to deal with reduced pipeline flows and low storage inventories that have supported higher prices. And right here we are seeing, I want to zoom in here, this is talking about the arbitrage, or the price difference between the U.S. prices and the European prices. And I just want to draw your attention to a couple things here. Right now, what we have is 115% Henry Hub futures. And what that is, that's basically the cost of the natural gas here in the United States. And then that 15%, that tends to be the cost to liquefy it, to supercool it down from a gas into a liquid and load it onto a ship. And then you've got here, as of right now, those futures are trading at about $4.38. You've got variable and fixed costs such as shipping, regasification, offloading, all those costs, about 66 cents and 57.5 cents. So a total landed cost for U.S. natural gas to Europe in February right now is about $5.62. But look at that TTF futures price, $31.94. That means your total arbitrage or your profit for every million BTUs that you carry, $26.32. So this American natural gas is immensely, immensely profitable when you liquefy it and you sell it into the European market. And we've talked about it before on this channel, folks. Price controls is not the solution. The solution to shortages is higher prices. And here we can see the higher prices being charged in the European markets has made more LNG available on the market as American producers have just scrambled to get as many boats into Europe as they can to harvest that arbitrage between the two prices. So that has caused more supply to materialize. Now, it's important to note that US LNG is not enough. If that weather in Europe gets significantly colder between now and the end of the heating season, US LNG cargoes will not be enough to maintain European natural gas markets. It will only help. The prices will have to rise. Now, again, the solution to shortages is higher prices because as those prices rise, you're going to see demand destruction like we saw in December when the European metal producers and the European fertilizer producers all shut down operations because they couldn't afford the power prices. Well, a lot of those operations have since restarted. If the weather breaks cold again and the prices start to rise, then those factories are going to have to shut down again. You'll have some of that demand will be destroyed by the higher prices. The solution to shortages is higher prices. And real quick, I just want to mention we have been tracking ticker symbol LNG. That's Cheniere Energy, and I just want to CYMA here, folks. I'm not a financial advisor. This is not financial advice. Do your own research, your own DD, arrive at a decision that's right for you based on your unique situation. But several months ago, I talked about how I had been investing in LNG, and at the time, I drew this little flag pattern that we were consolidating in. And then on my live stream a couple of weeks ago, I mentioned that we had broken below that flag pattern, but that I wasn't too worried about it because I believe the macroeconomic thesis behind this investment was still sound, namely because of the situation in Europe. So I stuck with the trade. We went back into that channel. Now we've broken out of it and we are onward and upward. We made a new high yesterday, had a little bit of a red candle today. I think what's going on there is between the European prices coming down as the warmer weather sets in and prospects of colder weather here in the States, we're going to start to see a little bit of a shrinkage in that arbitrage as you start to pay more for American gas and less for European gas. Obviously, the profits of liquefied natural gas could be squeezed a little bit, but I don't think that is going to be a significant enough effect to really limit LNG's earnings. I think this company is going to absolutely blow away estimates in their next earnings report. And I think this one is going higher. I have a short-term price target of $130 on this one. And I'm really just basing that on this previous move that we made between September and October. If we see a similar percentage move off of this low, that would put us somewhere around $130, which is where I would be looking to begin taking profits in this one, at least in the short term. And I just want to mention real quick, folks, that the big dark horse in this race, besides the weather, is this geopolitical risk and things going on with Russia and the Ukraine. And I saw this one today. This is in The Guardian. Russia threatens military deployment to Cuba and Venezuela as Ukraine talks stall. So Russia and the West and Ukraine, they have been sitting down and they have been talking recently. And that was a good sign that they're talking. But when Russia is threatening to send troops into Cuba and Venezuela, aka the Western Hemisphere, that is a sign that these talks are not going well. Remember the Monroe Doctrine? Remember that little thing called the Cuban Missile Crisis when parents were kissing their kids goodnight, not knowing if they were going to wake up the next day or if a nuclear war was going to break out and kill us all? Let's not have a repeat of that one. Okay, so the fact that they're talking is a good sign, but folks, talks not really going well right now. Russia seems to be getting more and more belligerent with their rhetoric. Is it a bluff? Does that mean that those tanks are about to roll into Ukraine? That's anybody's guess. But we have to keep our eye on that geopolitical situation because that is a direct input to energy and food markets for 2022. So we are going to keep a very close eye on that situation. So long story short, the state of the energy markets in Europe right now is basically hope for a warm winter and hope Russia doesn't invade Ukraine. That's really all it comes down to, folks, because Europe cannot produce enough energy to keep itself warm in winter, and the Russians have already started choking off that gas flow. The US LNG cargoes can help, but it's not enough to sustain the market. So if that weather gets colder or if those Russian tanks get rolling, those European energy prices are going straight back up where they came from. And there's really not anything the Europeans can do about that, at least not in the short term. Guys, I want to thank you for your time. Thank you for watching this video. Don't forget to give me a thumbs up, subscribe to my channel, and hit that notification bell. It really helps me out. Until next time, live small and dream big.